Excellent. What an informative session. Thank you, Anna, Vincent, Susan, and Peter. Up next, we have a great CoreLogic Fireside chat focusing on understanding catastrophes and climate change impacts on the property market, something that we should be very across. And so I look forward to that next session. Thank you.
Thank you for joining today's presentation. I am Milena Malev, General Manager of Financial Services and Insurance at CoreLogic Asia Pacific. CoreLogic is excited to sponsor the 2021 Mortgage Innovation Summit, and we are delighted to be talking about natural catastrophes, an emerging and ever-changing climate risk, and impacts of these risks on property market and financial industry. Climate strategy and understanding potential impacts of climate change and natural hazards on each property, as well as the overall resilience of portfolios, is very important to our industry. Natural hazards and climate risk impacts on physical assets is something that banks and insurers need to understand, manage, and report on. For many years, CoreLogic globally has been helping banks and insurers deal with impacts of natural disasters and providing property vulnerability and catastrophe modeling capabilities. In Australia and New Zealand, through our climate risk solution and partnership, we deliver comprehensive property data and climate risk insights, modeling and platform capabilities to support and help the industry to better understand climate-related risks and embed them as part of strategy and risk management framework. There is no doubt that climate change creates opportunities and challenges to the industry, and by working together, we can best combat climate change and financial risks arising from it. Joining me to discuss today's topic is Dr. Howard Botts, Chief Scientist and Executive Leader, Science and Analytics at Collogic in the United States, Tim Lawless, Executive Research Director, Asia Pacific at Collogic, and Dr. Pierre Wiart, Head of Consulting and Risk Management Solutions at CoreLogic Asia Pacific. Welcome, gentlemen. It is just over 12 months since the bushfires that devastated the nation, and it is almost a decade since the tragic Brisbane floods. Unfortunately, natural disasters have become part of our landscape. Brisbane floods had a profound impact on the insurance industry and the community. Suncorp paid out more than 200 million in claims and helped customers to rebuild their homes and lives. Tim, what can we learn from Brisbane floods and how it actually affected property market?
Well, the Brisbane floods was a relatively unique event in Australia, or particularly Queensland, because it did impact on such a large population base. For those outside of Australia, Brisbane's Australia's third largest city, home to about 2.5 million people, and broader southeast Queensland, which includes the Gold Coast and the Sunshine Coast, about almost a bit over 3.5 million people. So it did affect a fairly large population mass. And a bit of context, the Brisbane floods were caused by tropical cyclone Tasha, coupled with a tropical low during a La Nina event. So it was quite a mix of weather events. But what happened was we saw a lot of areas along the Brisbane River were severely inundated. And as you can see from the graph on this page, I've just highlighted some of the worst affected flooding regions or suburbs compared to the broader Brisbane average of housing values. The impact was quite immediate and clear. We did see housing values in these flood affected areas underperforming the broader Brisbane marketplace at a time when there was already some downwards pressure on housing values because interest rates were rising at this time. After a lot of the post-global financial crisis stimulus had been removed from the marketplace. So the market was already in a downturn. And then through the floods, we did see a much more pronounced downturn through those flood-affected suburbs. But the really interesting thing about this event was that we did see housing values bouncing back to their pre-flood highs within about 4 years. It took a little bit longer in those flood-affected areas than the broader Brisbane market. But if we look beyond that flooding event through to more recent times, we can see that each of these heavily affected suburbs has moved well beyond their pre-flood values. In fact, a lot of these areas are some of Brisbane's most affluent suburbs. There's a real affinity for living close to the water in Brisbane, close to the river. It has a certain lifestyle appeal. Certainly, we see that in the premium value of properties in that region as well. So it looks like for many Brisbaneites, the risks of flooding and the memories of the 2011 flooding event are well and truly behind them. And we have seen these flood-affected areas returning to their premium values, and a lot of people are certainly very willing and happy to purchase into these markets, despite the fact that this flood was only 10 years ago.
In March this year, it's going to be 4 years since Cyclone Debbie, and it was a severity 4 tropical event that left a trail of destruction across North Queensland and certainly impacted many Australian households. And if we look at science, what it tells us, we know that cyclones are expected to move further south. Pierre, what can we learn from this disaster and the expected move of cyclones? And what does this shift actually mean for the homeowners, bankers, and insurers?
Yes, thank you, Milena. Yeah, I've got actually a couple of points that I want to pinpoint here and I want to discuss. The first one is we looked at the impact of Cyclone Debbie, but also Cyclone Yasi. And in the last decade, and even the last 2 decades with Cyclone Larry previously, what we observed is that the impact of the cyclone on the property market are somewhat quite subdued. There's no massive impact, which is a little bit counterintuitive. And what we see is we analyzed, prices changes and rental changes, and also vacancy rates changes. And all in all, without getting into all the details, the key message is that the impact have been quite minimal. And in a way that helped to define what we call the Australian resilience, and which is certainly true in the property market. Now, it is an interesting place, as Tim pointed out. This part of Australia is so far the cyclones Debbie and Yasi have been affecting a relatively lightly populated area, but of course, Queensland is heavily populated in the south. And that brings me to my second point, which is about climate change. The current scientific studies point to the fact that cyclone and cyclonic wind activity are going to move more southward and effectively affecting a larger degree of the coastline of Australia. And that's where, as you know, where obviously Brisbane, the Sunshine Coast, the Gold Coast, and even the northern part of New South Wales would be or could be more subject to cyclonic winds. And therefore, Australia will not be immune to the impact of cyclone high winds to this very densely populated area. So as we're aware of that, I think one of the key message here is to know that given the concentration of value in this part of Australia, I think it's important for the banking sector to evaluate the present risks, and especially if this risk is going to increase.
Thank you, Pierre. It's interesting to see that Australia is somewhat unusual in terms of how loss of property affects our property market. I would say that we as a nation have almost a pathological connection to the idea of home. and it's certainly reinforced by high home ownership rates. Now, I would like to cross continents and talk to Dr. Howard Botts in Collogic, US. Howard, what can we learn from US and how a US property market reacts to natural disasters and impacts it has on financial industry?
Great question, Milena. The United States, like Australia, definitely, we have hurricanes, equivalent with your cyclones. We're impacted by flooding, bushfires, severe convective storms. So much like Australia, we have significant amount of natural hazard risks. And the US financial industry and regulators really are focused on three areas related to natural disasters. They want to know natural disaster impact on individual properties, literally immediately post-event. They want to understand natural hazards when underwriting commercial or residential loans. So what are the potential loss impactors for those? And then finally, in what ways is climate change going to impact future risk on a particular property? And in assessing the first of these, the natural disaster impacts in real time, we work very, very closely with the mortgage industry and loan servicers. A key distinction between the US and other countries in the world is the US homeowners can default on a residential loan and essentially walk away from their loan obligation. So that creates a completely different dynamic in the market and makes the loan originators much more keenly focused on what's the potential loss related to individual residential or commercial loans. And this means essentially that they're going to look much more closely at uninsured risks like flood and earthquake, which both of which take a separate policy, aren't part of homeowner insurance in the US. And then those companies that service these mortgages are on the hook to continue to make payments to mortgage bondholders, even if the individual defaults or goes bankrupt and walks away from the property. So to illustrate what I'm talking about, this first slide shows a number of the ways we look at real-time loss estimation at the individual property level using our weather radar-based forensic models. We monitor every cubic kilometer of the atmosphere 24/7, and using very sophisticated radar-based models, we can understand at the individual property level what is happening on the ground, from all the different kinds of damaging winds, whether they be hurricane, straight line winds, or tornado, or we can identify damaging hail and flooding. We very cleverly validate these on the ground footprints using social media, imagery, and text. People love to send pictures of big pieces of hail, broken off trees, flooding in their homes. All of these kinds of images we're able to use to map and validate what we came up with on the ground footprints. So within 30 minutes of any severe convective storm event or hurricane event, we can return real-time losses for each individual property that was impacted by one of these, or for an entire portfolio of properties. For end users that need immediate numbers for which of their properties were impacted, we actually house their portfolios in-house, run our models against their portfolio, and we can return those that are impacted, extent of the impact, and estimated dollar loss based on some very complex replacement cost models we have for homes. Other use cases include triage for the most affected properties, or resource deployment to get contractors quickly to properties, or for understanding which banks or ATMs or commercial structures are impacted by business interruption. One of our newest models is for flood, where every 24 hours we can tell you the extent of flooding and the depth of flooding anywhere in the US. And so there's 4 examples that I have here from real-time events showing hail or the derecho, the straight line winds that moved across Iowa and caused over $1 billion in damage last summer. Hurricane Harvey is a great example of real-time flood mapping, or tornado maps, which are unfortunately an all too common event across the US. If we go to our second slide, one of the things we look at is how can we help keep people in their homes, given what I said about the individuals being able to walk away from a loan or strategically default. On this graphic, we've tracked delinquency by different classes, by those that have a low loan to value ratio, so very little equity and lower credit scores, or those with high credit scores and a lot of equity. The top 2 lines on this show for those with low equity, what happens through time. They're roughly around 4%. Hurricane Harvey hits in this example, and then suddenly we see the properties that were impacted by flood go from 4% and jump up to 12% delinquency, eventually kind of tailing off. So in this case, we can see a significant impact on property owners and their inability to pay, clearly related to amount of equity they have and their ability to borrow on the through credit cards and other things. The bottom 2 indicate those that were not in a flood area. A slight bump up in numbers, but only because of properties that probably were related to the homeowner's place of work being out of commission. So hopefully, Milena, this gives you a little bit of a view as to how we look at real-time natural disaster impacts in the US.
Thank you, Howard. Very interesting insights from US market. But what about the future outlook? How are you using data in CoreLogic US to help financial industry to understand future risks?
Another great question. Thank you. Certainly, we're seeing almost on a daily basis, I'm getting phone calls to help the financial market understand future losses, whether it's from ongoing events or increasingly related to impacts of climate change. To answer their questions, we've developed a number of tools. One good example of that is what we call composite risk maps, where we've taken all of our major perils, and in this case that I'll be showing you, earthquake, hurricane, all sources of flood, wildfire or bushfire, severe convective storm, and winter storms. And we're looking at combining these so that we understand frequency, severity, and dollar loss. And by doing so, we're able to come up with a 0 to 100 score for every property in the US, as well as average annual loss or probable maximum loss over any time horizon, literally out to 500 years. And so our models typically look at where's the hazard striking, how is it propagated in the individual structure. We then look at percent damage to a particular structure, and then are able to generate a dollar loss. So these are very powerful in that we can talk about all hazards, or we can look at individual hazards. If we go to the next slide, I think it gives you a good example of what that might look like. We start out with individual properties, and then we can aggregate those up to a national scale. In this case, on the national map, it's postal codes. And you can see from the totality of risk, or the composite risk, we see certain patterns. Certainly California on the far left, earthquake, wildfire driving significant losses. Central US, it's severe convective storm, hail, wind, tornado. the coastal areas between Texas and Florida, or up the East Coast being driven by hurricane, and then up the Mississippi River Valley flooding, earthquake around Memphis is another issue. We can then zoom in on a metro level, in this case, the Dallas-Fort Worth area, or as you can see, we can go right to individual properties. And interestingly, even though you would expect some homogeneity, we see significant differentiation property to property in this example. So these financial institutions that I've talked about are building models for underwriting around these risk scores and other loss metrics. And in particular, since earthquake is a largely uninsured risk, we find a lot of banks using our earthquake models to make some sort of assessment about loss potential, and then decide whether they're going to write on that property or not, or whether they may require some additional form of insurance. If we go to the last slide I have here, the other area we're asked to do a significant amount of work on is climate change. And if we look at places like Miami, Florida, we're already seeing in some parts of that area, streets being flooded during very high tide events. You don't want your streets to look like Venice, Italy, but that's what's happening. We're seeing a 5% decline in some areas in sale prices, and a 10 to 20% decline in number of sales. And so already we're seeing climate change impact, and then we can model that out through time, through different scenarios. This is a major area of focus now, where we'll be able to tell you any property in the US for any time period, how much additional flooding or other natural hazard events we're going to get. And all of these are finding their way into mortgage underwriting and other things. So thank you, Milena, for letting me at least talk a little bit about what we're doing in the US context. I appreciate it.
No, thank you, Howard. Now back to Australian market. Pierre, what are we seeing in Australia? How insurers and financial industry is dealing with natural disasters and climate risk?
Yes, thank you, Milena. What is certain, or what we've seen here in Australia, is that clearly out of all the finance sectors, the insurance industry has been the one which is the most ahead of the game in order to understand and to evaluate those risks. And that has not been, if you want, translated or used so far in the banking or in the investment sector. So here we've got an opportunity, because CoreLogic has joined or partner with Munich Re in order to integrate and evaluate all the various natural hazards that we observed here in Australia. And we come up with an equivalent of the composite risk that Howard was mentioning in the US. So we've got also this combined view of all the natural perils that could affect various regions here in Australia. Now, interestingly, the difference between, if I may say, Australia and the United States are often identified with pockets of specific natural hazards, such as cyclone in Florida or earthquakes in California. But here in Australia, often flood or drought could also occur in the same region. So it's important to understand that all these risks do aggregate. In the same way as what Howard mentioned, here in Australia, we can go down to the property level, and that's what this slide shows. And we can identify which properties would be most affected by overall combined risks. Out of that, from a portfolio manager, you can evaluate the amount of property which is at risks. You can use the valuation that we provide to understand the overall impact to the portfolio, and effectively identified what is at risk and what needs to be addressed in the future as a portfolio manager. So it's important to realize that these models are scientific assessment of the risks. And so they have a better and enhanced view compared to, say, a historical perspective of a flood that happened in one region only. So they're more complete and offer a broader picture of the risks. Now, in my next slide, I also show that the data we've got is not just the list of current hazards, but there's also some future outlook, future scenarios that follow the IPCC, the International Panel of Climate Change, and that projects what would be the view in the future. These views really help you to understand the trends in one of these specific perils, such as flood or bushfire, or even coastal erosion with the sea level rise. So it really helps you to have a more practical understanding of the value at risks in your portfolio. And so this information can help you integrate in your origination process, integrate those risks and identify what needs to be known before, if I may say, underwriting, taking these risks on your balance sheet. And so it would help raise flags and discuss and requires the attention, if you want, of the credit or the portfolio risk managers. And perhaps as a final comment, it can also be used to install a dialogue with your client, with your customer, and have a better relationship with them to discuss what is potentially an issue for them in the future.
Thank you, Pierre. Very clear takeaways for the audience here. This is great. I do want to finish on an important aspect, and that's the consumer trends. As we mentioned, Australia has very diverse landscape, and it's vulnerable to quite a few different perils and severe weather events. Tim, how are consumers responding to climate risk?
In varied ways, Milena. And if we look at the major population centres, say the capital cities of Australia, we're not seeing much impact at all on property values from climate change or hazard risk. If you only have to look as far as, say, Sydney Harbour, and we're seeing fairly frequently examples of properties selling for in excess of $20 million and setting new records for harbourfront properties. But I think as we start to see more examples where properties are being affected by climate change, some recent examples would be some events we saw around New South Wales Central Coast, around Wamberal Beach, where there were properties literally falling into the ocean due to coastal erosion. We've seen similar examples around the northern beaches, Narrabeen, for example. So when we start to see these really high-profile examples of properties being affected by climate change, I think it starts to become much more real for prospective buyers. Maybe another way we might start to see property values being impacted as well through climate change is simply through additional insurance costs as well. So as we do start to see this risk being measured more effectively and more appropriately, and those costs being passed on to homeowners in the sense of higher insurance costs, then that could also flow through to be a natural disincentive in some of these markets. Once you get outside of the metro regions into some of the more, areas that are affected by cyclonic activity around northern Queensland, for example, or areas that are synonymous with bushfires, that's where we already seem to see the risk is already baked into the prices to some extent, where we do see bushfire examples around the Dandenongs or some of the more prestigious hinterland areas of Australia that have been fire affected, areas around those markets don't seem to go through as much fluctuation in housing prices as those impacts are much, wouldn't say more common, but probably already factored into the housing prices. So going forward, I think as we see more and more effects of climate change, this probably will start to impact more on the premium being attracted for, say, waterfront housing or hinterland markets that are quite popular, also flowing through to things like town planning. Where can we see homes actually being allowed to be built or being renovated and so forth as well, has some significant implications.
Thank you, Tim, and thank you, Howard and Pierre. What a fascinating discussion. I would like again to thank Tim, Howard, and Pierre for joining us today and for this great discussion on such an important topic for the industry. Thank you.